All right, it's 10:05. I want to be respectful of everyone's time and we'll get things underway. Good morning. Thank you for joining us. This, like I mentioned at the beginning, during the introduction, this is a new time for us to test webinars out. We usually get a great turnout in the evenings, but we also get the feedback. A lot of people can't show up. They've got family obligations. So this is our opportunity to give the other side of the day a chance to see what we do at Happy Camper Capital. And also what we're doing with the Outdoor Hospitality Sun and Fund. So we've had requests for more information on our industry. We've got a lot of new folks entering this asset class from other investment asset classes they've been in. So today is meant to be completely educational and informational about not only our fund, of course, which we're happy to share with you today, but also just the industry and why we are such proponents of the outdoor hospitality space as an investment vehicle. So to introduce myself, my name is Adam Lundy. I'm one of the founders. I'm one of the operating principals of Happy Camper Capital. Justin Hoggett, who was my co-founding partner, he is actually in the other room right now. He was not able to get in the Zoom room, unfortunately. But Don Spafford, one of our partners, is on. We've got other team members on. Ramesh Nachapan, who's one of our investor relations staff members. Bradley Claudianos, who is one of our acquisition specialists. So they're going to be representing us here this morning. We'll be happy to answer any questions you have. If any questions do come up, please put them in the chat. We'll make some time at the end to address those questions. Just get them in there early so we don't forget them. We'll leave some time for those. And of course, if there's anything that needs further explanation afterward, we'd be happy to schedule a call with you to get those questions answered for you. So today's going to be three-part. We are going to talk a little bit about the Happy Camper process, how we run our deals, how we operate. We're going to talk a little bit about the industry itself, and then we're going to talk specifically about the fund and why we think it's important. So to start off, let's talk about how Happy Camper Capital operates, what it is we do and how our process works. So to put it simply, what we look for is both performing and value add RV resorts, campgrounds, and marinas that are, we set goals to attain above average cash flows on those, asset appreciation, of course, over the long term, hold of the investment, and then also to create tax benefits for the investors who come in through depreciation. Just to clarify this, we buy destination campgrounds and resorts. These are vacation properties. We're believers in this space and having a transient population user base. What we are not buying is we don't buy trailer parks, mobile home parks. We're not buying long-term residencies. That's not the model we are pursuing. There are different arguments for this. We believe that, of course, this is a space that is growing. It's in increasing demand right now. And also it has more opportunity to generate what I like to just coin as torque on the revenue side to really be able to boost the performance of these businesses that we're investing in. So our process is really 5 steps. First is going to be locating. So one of the things we do, of course, is we locate properties. We don't just rely on brokers. Brad Claudianos, who I mentioned, who's in the room with us, he's one of our acquisition specialists. He is one of our guys who is out finding deals on a regular basis. We do have relationships with brokers who bring properties to us. However, this is a high demand space that we're in right now. And the deals that are usually brought forth by those brokers are seeing a lot of competition and compressed cap rates beyond what we even think the market's at sometimes, just because the demand's so high. So we do pride ourselves in finding off-market opportunities. Many of our opportunities that we have are off-market. Nobody else is competing with us. This is a still predominantly mom and pop space. So there is a lot of opportunity in finding and sourcing our own deals. Next, what we do, of course, is we are an end-to-end solution, everything from finding the property all the way through purchasing and operating it. The next thing we do, of course, we negotiate. We make sure that we're getting the best deal we possibly can, the best terms, the best price. We do our own contracts. We do our inspections and due diligence to ensure that we're buying the right properties. This is a very complex process. So, we'll get into a little bit more of what is involved in that, but this is a lot heavier than your typical real estate assets or even some business assets. It's a large real estate asset, and it's also a large business asset that we're inspecting at the same time. Once we feel that it's an opportunity that we want to bring forth to our investors, and we highly scrutinize these, I would say we pass over a lot more than we actually move forward with. I see Brad nodding to that there, so I think he can agree with that. We do hold the high standards on what we bring forward, but after that, we present the opportunity. So much like we're going to do today, we're not going to necessarily talk about a specific opportunity, although we do have one in the fund right now, which you'll be able to see after our presentation today. However, I will be presenting the fund and its mechanics to you today so you can understand that. Once we have, of course, raised the capital needed to make the purchase happen, to make the improvements that we are looking to do happen, then we work on the onboarding. And that's with our management team at Beyonder Camp. We do own our own management company. So when I said we are comprehensive and end-to-end, I truly mean it, all the way through the operation, continued operation of the campgrounds going forward. So buying these are very complex. Like I mentioned, there's a lot that goes into getting your first RV destination. In fact, so much so that we actually have created our own course for the team members we bring in on how to do this. It's something that just rolled out recently. I'm going to be sharing some excerpts from that with you on the next slide here in just a minute to talk about, just to show you some of what we train our guys on when they're looking for these properties. But the biggest thing, of course, is deal flow. If you relied only on brokers, there's just frankly not enough deal flow. I would say that we pass on 95%. I'm just going to throw a number out there, 95% of the opportunities that come from brokers. We don't even bother looking into further because frankly, they're overpriced or there are other things wrong that we just don't want to move forward with. Unlike other assets where you can rely heavily on cap rate is really not something that you can hang your hat on this. Although we see higher entry cap rates than a lot of other asset classes, it's not always going to be an indicator of how these perform. Our model is a remote management model where we hire a manager who we put on staff in the campground who runs the operation and is the main point person for that operation. And in some of the operations out there, just installing that manager and adding that one salary to the payroll will take a lot of the effectiveness of them out. So cap rate alone is not everything. However, I will say that we do traditionally trade in a higher cap rate than other real estate assets, which is provided the demand continues to increase as we expect it will cause that cap rate compression over time, which of course is what brings us the added value to these properties. There are multiple formats to these. So transient versus long-term. Like I said, we favor the transient market. Now, long-term doesn't necessarily mean it's a residence. Some long-term is people stay for a series of months, like for a summer or a season. This is prevalent in the Sunbelt states, like in Florida. We get a lot of snowbirds that go down and stay from November through April. Those are models that we will explore. Like I said, we just really stay away from the residences per se. We do want more of that transient population. We have a lot more opportunity to improve the rates on those, the average daily rate, as opposed to the long-term tenancies. There are a lot of systems that go in these, as far as just the infrastructure, the different water options, whether it's on city water, city sewer, or if we have a well and a septic system. There's a lot that goes into just inspecting that infrastructure, understand what we're getting into. We have our own criteria we look at, while we do have properties that have wells and septic systems, obviously city water, city sewer is preferred, but if the business makes enough sense, we go with we balance our risk going into these. The financing is definitely a little different than other assets. This again is one that has not been an investment grade asset for a long time. Not a lot of operators in the space have been doing what we do in this. It's been primarily mom and pop who get SBA loans in a lot of cases to finance these purchases. Traditional banks haven't seen enough of these come through to where typically we are getting recourse debt on these properties. So that is a big consideration for us. And it's just a little more of our investment in these deals, and why we scrutinize these so much is that our names are on the loans for these properties in most cases. So there's not much non-recourse debt in this space. So it's just something that is just kind of another testament to our belief in this, is that we're willing to put our own names and social security numbers on a lot of these notes that we're picking up on these properties. The business plan, this is some of the heaviest underwriting of the whole thing. Knowing how we're going to take a property, especially when it's already performing, and improve it. So we'll talk a little bit more in the next section of how we do our business planning, but that's one of the biggest and most important components of what we do. And then of course, the due diligence, like I said, is just, it's everything. Analyzing the financials, the operations, getting on site, actually inspecting the systems, working with contractors to inspect the things that we can't inspect, environmental surveys, just all the protections and precautions we can take to make sure that we're buying a sound purchase and something that's not going to be a larger liability down the road. So that's how Happy Camper operates. I'm going to talk a little bit about the actual process of buying a property. So this course was originally created to be an onboarding tool for our team members coming in, to bring them up to speed in the industry and teach them, how to actually run our unique process. I'm going to share some excerpts from it today that will help you better understand the space as it relates to RV destinations. So this is a great space to be in. There are a lot of reasons to buy into the space. We've seen huge growth in the past couple of years. Some of it was accelerated by COVID in 2020. Some of it was already headed in this direction. We had a lot of digital nomads who were taking to the road, and that's just somebody who works and lives on the road. In fact, we employ a couple of those on the Beyonder Camp side. We have two couples who are both digital nomads. They both we actually came to us already on the road working, and now they continue doing it with us. It's a popular space, especially with millennials. Some of this has to do with just the way housing costs have risen over the past several years, making it inaccessible for a lot of those millennials coming of age. So they've had now jobs that have turned remote in 2020 that they're able to take on the road. So that is a huge user group who we are seeking, is the young family. On our operations side of Beyonder, that's actually our target demographic, knowing that if we give them the amenities they want, good Wi-Fi, clean facilities, that we're going to attract everybody else, all the other age groups as well too. Of course, we even found in 2020, we were in an economic recession in 2020, and this asset has thrived. Although, we don't know necessarily what the next year is going to look like in our economy as a whole, the surveys that are coming out thus far within the industry are showing that people will pick RV travel over other forms of travel if they become inaccessible or too expensive. And what we found is for those who have RVs, they will still typically get out and use them. So some of our selection criteria will come into play, and why that's important, and why what we choose to purchase has actually served us well in this environment we've been in this year, being in a recession, and with fuel prices where they are, something that you'd think would typically hurt this asset class. So we'll talk about that as we get a little bit further along. All right, so you've heard me use the term RV destination, and there's a reason for this. RV park is a term that gets often used. We've got a little bit more lingo in our space. So if somebody uses the term RV park to me, I picture the thing off the side of the interstate that you can see that's basically a parking lot. It has no amenities. It's really just meant to be a place to pull off and stay for the night before you get onto your next space. It's not a destination. It's frankly on the way there. This is a space that we at Happy Camper have not typically pursued. Some of this was just because when we formed in 2020, we saw that space was hit particularly hard. There wasn't a lot of interstate travel. More people were staying in their home state. So those were actually the only RV destinations we saw who saw a downturn in 2020. And I would expect they're seeing it again with the fuel prices where they've been now, as more people like to stay within about 3 hours of their home. The properties we focus on are these middle two, the RV campground and the RV resort. So an RV campground is a place that is not necessarily the destination itself, but it's near a destination. It has enough amenities to encourage a long weekend or even a week stay. Some people stay longer than that if they're seeing family in the area, but it is in itself a vacation spot. It might be near the attraction that people are going to visit. So RV campgrounds are definitely an asset that Happy Camper purchases. The second is going to be RV resorts. And these are going to be more high end. So think the place that the big buses go, the big $500,000 plus buses go to stay. People are going to go stay there long term. They're going to be there for maybe weeks, even a month. Extended visits. They don't have to leave the property. It has premium amenities. It has the things that will make them want to stay long term. And then, of course, the final is RV communities. And these are going to be more or less long-term living. So these are prevalent in Texas is a great example. Most of the RV properties we run to in Texas fit this model, where they are residences, people live, they are on long-term leases. This is not part of our model with Happy Camper. We just don't see the opportunity to create the long-term value that we strive for in that space. As I mentioned, of course, before, this has been primarily a mom and pop space, heavily driven by, family operators. I don't have an exact statistic, but I would venture to say it's in the 80 to 90% range still, although that number is declining as more institutions get into the space. A lot of newer owners who've come in have become remote owners, where they want to own the property. They don't necessarily want to run it. So they hire a manager, or they hire a third-party manager and they own it and have someone else operate it for them. And then, of course, there are the institutional groups. These are some of the big guys. As far as investment in the space goes, the institutions have really been the only ones, such as Sun Communities, who've been in this long-term since before about 2020. Most of these smaller investment groups or the remote owners really came into play after that time. All right. So I mentioned, of course, the transient versus the resident, and there are a lot of reasons why we prefer the transient. One of the biggest ones being when we formed this model, we were in the middle of an eviction moratorium in 2020. We actually felt as landlords ourselves, some of the side effects of this. So we recognize the importance in having users that could be filtered out if they weren't paying. And of course, these are vacation users, so we aren't kicking people off of a residency per se. If somebody's not paying or if they're violating rules, they can be removed because, again, this is not their residence. This is just a place that they come to use with permission. So that's one thing we like. Of course, the biggest thing we really like about this, though, is the ability to increase the revenue from camping using technology tools. So we've got software solutions which will allow us to actually increase the daily rates based upon our occupancy, based upon holidays. This is one of the biggest, most important things we do is we implement an online reservation system, which a lot of these campgrounds haven't had at the beginning, that will first off just get you new users who wouldn't have ever found you otherwise. I did mention that millennials are the biggest user group in this space right now. Most of whom are relying on their smartphones to find the place that they're staying. So you have to have online reservations, you have to have a web presence, you have to have good marketing to be able to be found to get those people in. And then, of course, as your occupancy increases, as more of them come into the campground, the nightly rates go up, and then we're able to maximize our revenue stream. So that's one of the big things we like, that you don't have that opportunity when you have residents on site. Now, there are two main types of RV destination properties, what we call seasonal properties and year-round properties. Now, this is a little bit of a misnomer. There's no property that's truly maximized potential year-round in this space. Every property in the country has seasonality to it. It just depends on when that seasonality is. So when we use the term seasonal property, we mean one that can't be open during a certain part of the year. So think northern states where it gets freezing cold in the wintertime. It's maybe inaccessible. The utilities can't be turned on. It has to be shut down for a number of months. You're relying on that operating season to generate all of the revenue for the year. Whereas, say, a property in Florida still has seasonality to it. Although its seasonality might be November through April, there are opportunities to make revenue May through October. So it's just, and that's one of the challenges we like, is being able to go in and find out how to maximize those off-peak months. Because typically when we're buying these campgrounds, in most cases from a mom and pop, they get tired. They spend their peak season working 80-hour weeks and they want the time off. So a lot of them are happy to shut their operation down or severely limit the operation in those other months of the year so that they can catch a break. I can't say I blame them for it. However, our model, especially with our ability to add a payroll to these properties, allows us to explore other ways to expand our operations in those. So we love both seasonal properties and we love year-round properties. You know what you're getting when you're buying them, because you're buying them based upon the prior owner's performance and business operation. So if you can find ways just to extend that season or add more to it, you have easy ways to improve your revenue. Okay, we'll talk a little bit about some of the amenities and the features that we looked at. We generally break this down to three main categories. So basic features are going to be anything necessary to keep the campground operating. This is going to be your infrastructure. This is going to be your staffing. These are going to be the core expectations, that you have water, that you have electricity, that you have sewer, that you have access to emergency services. These are some of the things we look at underwriting. These are the things that if you don't have them, you're not going to be able to open your door or at least meet our expectations of an operation. And then outside of that, you have what we call direct and indirect revenue generators. So when I talk about a revenue generating amenity, I'm talking about something that we have a measurable connection to dollars in from adding that amenity or that service. Whereas the indirect ones are going to be the ones that maybe are harder to measure, but we know will drive it. So, for example, paving a road in a campground that's otherwise got dirt roads will allow you to improve your rates. You won't necessarily see the actual revenue correlation to it, or it could be improving the landscaping, adding a playground or a swimming pool. Well, you might not have a dollar to dollar or a dollar amount tied to that directly. It will indirectly improve it. So these are categories we look at when we go to create our business plan, when we do our underwriting, to see what our opportunities are as we go forward. One of the biggest things I already mentioned, of course, is having those online reservations, having the ability to get people who otherwise wouldn't have seen it, to actually find your campground, be able to make a reservation, to be able to add some upsell opportunities when they're creating the reservation, to allow them to rent a golf cart or to have their firewood pre-purchased and delivered to their site when they get there. Some of the others we look at, we like adding liquor sales. So we can sell packaged beer and wine out of our stores. That's a great revenue source. The ability to sell food via a snack shack or through your camp store. Many haven't had that when we've gone in. Selling RV parts and accessories. If anybody in the room has traveled in a camper before, inevitably you're going to break something or lose something in your travel. You're going to forget something behind. Having the ability to sell those things is definitely worthwhile. You'll definitely, great way to make some extra revenue. And of course, like I mentioned too, adding a concession stand can be an option too. These can be complex depending on the states we're in, because they will typically require a food service license, but we've also had great revenue come from adding some of these sources in. So some of the other things we like are having rentable equipment for people to enjoy while they're on the property, because again, we are targeting people who are going to be there longer than just a night, weekend, week. So having golf carts are incredibly popular. They are a great revenue source. We rent these in most of our campgrounds between $50 and $80 a night. And the cost is much, much lower than that. Having it watercraft, we always like campgrounds that are near water. Water attracts people. So lakes, rivers, things that bring people in, ponds on some of these campgrounds where you can have boats, canoes, stand-up paddle boards, things like that. Those are incredibly popular. Rental bikes and even ATVs in some cases can all be good revenue streams. It just has to fit with that particular business. So there's not a one size fits all solution. These are definitely case by case, which is part of what adds the complexity to it. But adding events. So events are a big thing. We have a number of free activities and events that we provide at our campground, but also looking at the opportunities to provide paid activities. A great example would be things like a fishing guide. We have a marina out in Missouri that we have a fishing guide who operates out of there, and he takes people out on fishing tours. And I can attest that he's good. He took my son out and they caught 28 fish in about an hour. So, having those opportunities, you can provide people, create memories, will actually bring other people in from the outside who may not have even come to use the campground. They'll come for those other activities, which really gives us the opportunity then to open up for day passes, where we can, have people from the local community come use the swimming pool, the playgrounds, the facilities, the different games we have, and they'll pay a daily fee to do it. Anything we can do to provide a tour, additional activity, the more we add, the more people will extend their stays and want to stay long term. And then we look at how we can expand rental options for the actual stays themselves. So I mentioned, of course, RV is our staple in this. However, there are other ways of people staying with you that will enhance this and also enhance the revenue. Glamping is hot right now. If you're not familiar with glamping, it is glamorous and camping smashed together. The idea is that it's a high-end camping experience, usually in a very unique stay. Some of these are big canvas safari tents that are done up nicely with furniture inside, and or some of them are even covered wagons, teepees. There are a lot of options out there that you can stay in, and people right now are paying a premium for this. We do not put this as a cornerstone of our business because frankly, it just doesn't have enough history yet. We'll add a few glamping units in on our sites, knowing that these are typically an investment we can pay off within about 2 years, and we'll see a very quick return on. So if the fad were to fade, we would at least know that we have our units covered, but we still, our cornerstone is is the RV sites. And then of course, cabins have long-term history. They usually fetch great nightly rates. They usually can be opened year round as long as the utilities are set up with them correctly. So we can rent those even in the winter times or the off-peak months. The ability to expand. So having extra acreage that we can develop on, provided the demand exists, is something we always look for. And then even other ways that we can, again, maximize the use of that land. If we are in an off-peak season, we can provide RV storage. So if we have extra fields, or even sometimes the RV sites themselves, if we have to winterize them because the water isn't meant to be left on year round, we can charge people a monthly rate to leave their RV stored there during the off-peak months. Just anything we can do to improve those revenues are things that we're exploring when we go in. So I talked early about the fuel prices this year. That's usually one of the first questions I get, at least in 2022, when diesel topped $5 a gallon, unleaded gasoline was not far behind it. Is are people still camping? And I will say yes. We've seen this in our reservation data that we've been able to pull. It's just been a change in how people camp. So what we've found, and this makes a lot of sense if you think about it, is that people are still going to get out and use their toys. They're just not necessarily going to want to drive cross country. I will say that my family and I, we're in Denver, Colorado. We took a trip to Moab with our camper, and it cost us about $700 in fuel round trip. That stings a little bit, and for some people that wouldn't even be an option. That was a 6-hour drive. What we have found is a lot of people are willing to stay within 3 hours of their home. So one of our selection criteria is that we actually look for major metropolitan areas, and we put about a 2.5-hour radius around that. And we actually like to see at least two major population centers that are within that 2.5 hours of the campgrounds that we're purchasing. And this is for a lot of reasons. One of those, it has turned out, has been just for the users themselves. Those ones who don't want to spend a lot of money, who want to be able to get out and back on a tank of gas when that tank of gas right now costs them maybe $150. So they'll stay within that radius. So we found fewer interstate users, more intrastate users, more people who are within 45 minutes, 2 hours of their home. They've been some of the bigger population of our users in our campgrounds. But this also plays into finding staffing who's willing to commute, because again, those fuel prices are going to come in. And if you've got someone working for a lower hourly wage and they've got a 45-minute commute, they may opt for something that's a little closer to home. But in addition, of course, we always need contractors. We need suppliers, food suppliers, suppliers of different products that run the facilities. So we find it's best to be within proximity of major population centers. And what we found, at least this year with fuel prices specifically, is that this has been a great play for us. It was somewhat intentional, somewhat inadvertent, but it has served us well. As with any other real estate investment, of course, we're always looking to make sure that the property we're buying is in an area that's experiencing growth. We look for signs, of course, of shrinkage. We want to make sure what kind of industries are in that space. Make sure that we're not just hung on one economy, that it's a certain factory that drives an entire town, and if they shut their doors, that we'd be shutting ours behind them. So we look for multiple industries that are big in that space. Just to make sure that we're buying in a sound area that's going to experience that we can grow with. So talk next about the actual business planning that we go into. Some of the things that there are a few main strategies that we use when we go into this. And I will say that one is to maintain and grow. So if you see an operation that is running well, it's a well-oiled machine, they've thought of everything already, or at least everything you think you can think of. The plan in those can be just to go in and keep running it the way those owners have been running it, knowing that you're going to see growth from that. It might be a little slower growth, but it's typically a safer play. The other is going to be, of course, changing the format. This is one that we typically don't explore. This is a more high risk approach. This is going to be one where you're taking maybe that long-term residency in Texas I was talking about, and you're going to try to flip it into a vacation resort. You're trying something that hasn't been done before. So that's what we see as a little bit more high risk. And then there's the option to change the products and services, make some tweaks. This is what we call a balanced risk approach. So of course, like I said, when you're maintaining the operation, the idea is that you're just going to keep running it the way they have. You're going to work toward making those price increases. You're going to cut your expenses. You're going to spend a lot of time working on the business finance, just optimizing that, and then just being able to keep the rates going up to keep the revenue driving. Again, like I said, it may not be the quickest growth approach, but in some cases, this is the right fit. If you see that the current operators are doing a great job, and it comes with typically the lowest risk because you've seen the history of the property and you know that you can, at a minimum, as long as you provide the level of service they did, achieve the same or maybe slightly better results. The change of format, like I mentioned, this is one we typically don't do unless we saw the opportunity and we were able to conduct the proper feasibility study on this to make sure it's going to be the right fit. This would be when you're completely flipping the whole thing. Again, it could be a great opportunity, but it comes with the highest risk. It's not one that we at Happy Camper typically prefer to pursue. What we do typically like is, like I mentioned, the more balanced approach, which is going to be looking for expansion opportunities, looking for value add opportunities to bring in services that have been lacking and needed, to add new amenities, to add things that are going to improve the experience, continue with the same format that's been in place, and continue growing the operation. What we found in most of our projections is that this is the best approach to ensure stability and also potential on these. So some of the things we look at when we forecast the income is some of the considerations we make when we go into a market is we don't just assume going in that we can always increase the rates. We do our own comparative analyses to make sure that there's actually an appetite for higher rates or a possibility of achieving higher rates based upon the competitors in the area. Some of that we look at, it has to do with saturation as well too, just making sure that there is not too much saturation in the area to be able to get to that point, or that could potentially hurt our growth and our opportunities to improve the revenues. Obviously, there's no guarantee in the occupancy increasing just because we expand. So that's something we always have to consider as well too, as we look at who our user bases are, why people might go to that area. There's a lot that goes into selecting a market and what amenities, what the draw is of that area. One of the biggest things when we're forecasting our projections on is that we don't always expect we're going to see or realize the potential revenue the first year of our expansions. Typically when we add new RV sites, it takes a little while to get those up and running. What we're typically seeing is it's about a year from when the final, when the sites are open to when they actually hit their maximum potential. So, when we go into some of these expansion plans, we know that as we're adding, when we're injecting revenue into the capital expenditures, that we may not see the return on that for a year to 2 years in some cases. So, although we expect high returns on the back end, we typically know that there is going to be a stabilizing period for us to get the business plan implemented and to get the cash flow moving. Expenses, of course, these are something that, this is usually where we have the opportunity to optimize the most. If we've had an owner who has been running high expenses, a great example is one of the properties that we have right now that we're working on. It is actually in the portal, on the investor portal. The owner contracted all of the operational services out. So all of the maintenance services for the property contracted out, and the expenses were obscenely high. Now, we know from underwriting enough of these properties, that was a major opportunity for us. One of the big things we do know, though, going in is that we really, and I'll talk a little bit more about insurance, but we pay a lot of money for insurance. We have a very high standard on what we buy for insurance. I'll talk about why that's important, but we do expect that to go up in a lot of cases. And of course, property taxes after a reassessment are typically going to go up as well too. Sometimes in some states, they're assessed in different ways, and they've been stagnated for years, and we'll expect a very large increase. And of course, our variables, we expect those variable expenses to rise when we increase our occupancy, when we expand our operations. Some of those, like electricity, will definitely go up proportionally with the occupancy, which is why it's important. One of the big things we do now, all of our campgrounds, is we install wireless electric meters so we can recoup that cost. This is becoming increasingly more important with the rise of EVs, electric vehicles. We'll discuss that a little bit more as we move forward too. Staffing is a big thing. Like I mentioned, this is actually one of the things that screens out a lot of the properties we look at. A lot of these mom and pop operators, in many cases, mom and pop themselves are doing the jobs of about 3 people each. I don't envy their workload. Typically they'll be the ones taking the early morning phone calls, running the store until it closes, and handling all the maintenance calls, throughout the night when power goes out or different things happen. And they're typically tired at that point. So for us to bring in enough staffing to replace them in a lot of cases pushes a lot of properties out of feasibility. So this is actually probably where we lose the most properties that we underwrite. So when we bring one forward, we know it's one that we can put a reasonable payroll into. And of course, in this competitive labor market right now, we're having to project for higher hourly wages, higher salaries for managers. There's a work camper model. I'll just very briefly discuss that. It's one that a lot of campground owners, a lot of mom and pops have used for years, where they barter a site rent for labor with their staff. And that is a high liability area that we don't touch. That's something that would put us in high liability if that person were to get injured, for say. That's the simplest one I can say is workman's comp won't cover them, and we'd be on the hook for a medical bill. So we do plan on paying or we do expect we pay all of our employees at least minimum wage. We do provide them employee discounts to help them, cover some of those other expenses, but we want to make sure that we are legal and that we are protecting ourselves from liability. So that's a big consideration we make when it comes to staffing. Last note I'll leave you on before I get to the fund itself is insurance. I mentioned, of course, it is one of our largest line item expenses, second only usually to electricity and payroll. They're usually those 3 are the biggest expense items we see. We don't skimp on insurance. We have a great broker we work with who knows what we expect. We want to make sure that every asset on the property is covered for its replacement value, that we are covered against liability, the most common liabilities. We carry a very high coverage on the liability. And one of the most important things we put in place, especially because we are accountable to our investors, is loss of business income coverage. And we set that loss of business coverage at our preferred rate of return. So in our investment, if we were to suffer a loss from, say, a natural disaster that affected our ability to generate revenue for a year, the insurance would kick in and at least cover the investor prep to make sure that we are holding up good on our end for what we're returning. It's not uncommon for us to see a lot of mom and pop operators who really skimp on the insurance, and we see insurance policies sometimes that cost as much as a traditional homeowner's policy. So a lot of liability being left out there. It's not something we touch, in part because we understand the risks of it, but also because, of course, we're not investing just our own money. We're investing with our investors as well too. So with that, I'm going to present the opportunity now that you know a little bit more about how Happy Camper operates, a little bit more about the industry. We're going to talk about the opportunity at hand and why this is so important and something that we saw the need for. As I mentioned, this is a seasonal asset class in outdoor hospitality. This is something that we see a lot of our revenue come in a very short period of time. And it's not typical. If you're coming from multifamily, self-storage, any of these other asset classes that typically see consistent year-round cash flows, as I mentioned, even if you're buying in the Sunbelt states, we're going to see seasonality. We're going to see typically most of the revenue for the campground is going to come in 2 quarters of the year. And in some cases, it'll be very little in those other 2 quarters, to where, if there were distributions available to be made to investors, it could be much lower in some seasons. Sometimes the way the revenue comes in is off. I'll give you a great example would be if we have a campground that has a lot of seasonal users. So resort property where people go out to visit for the summer and they pay a seasonal rate to be able to come out and use their camping site or their marina slip on the weekends. A great example is our marina in Missouri receives nearly half of its revenue, not even during its peak operating season, actually, which is in the summertime, but it receives it at the end of Q4 and the beginning of Q1. As those people renew their contracts for the year. So cash flow comes in at odd times. And what it's created unequal distributions, so that you might get great cash flow distributions some parts of the year and very little other parts of the year. And of course, we've had a demand from a lot of users, especially those who are planning their retirement income, that they want to see consistent year-round cash flow. So one of the ways we saw to be able to attack this was by putting together a fund that blended multiple markets. Now, that's going to mean that we have markets that see their peak operating season in the spring and summer times, and those that see their peak operating in the late fall and winter times and early spring. Giving us a chance to blend, potential cash flows from all seasons of the year. So that's one of the objectives of the fund. The other, of course, is with that same diversity in markets where we're not necessarily honing in on one market, we're just honing in on the asset class, is that we have a little more diversity from things like natural disasters or events that could affect travel through a particular area. Weather events that could maybe take out an asset completely, making sure that we still have other performing assets in the fund that are going to help balance out that cash flow throughout the year. So those are the main objectives of the fund. The way the fund operates is that the fund will be targeting to acquire between about 6 and 8 properties over its life. The Outdoor Hospitality Sun and Fund is a $25 million fund, just launched this month, November 2022. It's going to be open for 1 year. The plan will be to raise the capital in that year and then deploy the capital. We'll begin deploying as soon as we hit thresholds and have properties ready along the way. The plan will be then to deploy all the capital within a year following the close of the fund. The expected overall life of the fund will be 8 years is what we're looking at. And the reason for that being, our model has been a planned 5-year hold per property that we acquire. And that's to give us time to buy the property, implement the business plan, typically in the first 2 years, stabilize the income from those new improvements made, and then have another year just as buffer as we plan for the sale and liquidation of that property. Because we're looking to raise over a year, then deploy over a year, that means that our last asset could be purchased in 2024, mid to late 2024, and we want to make sure that there's adequate time to hold that property and complete all liquidations before the close of the fund. That's not to say that it's necessarily locked into an 8-year fund length. That's the maximum length that we see for this opportunity. There is potential we may liquidate those properties and close the fund sooner, as long as our goals are met that we look to achieve. The ownership structure that we are that we are rolling out on this is a 65-35 ownership model. So 65%, of course, the investor members, 35% to the general partners. We have 3 share classes. I'll talk a little bit more about those in a minute and how we've created some incentive to those. We are targeting quarterly distributions when distributions are available. Those distributions begin at the end of a first full fiscal quarter for each operating property within the fund. We can't promise a distribution after an incomplete quarter within that fund, and I should say we can never promise a distribution. However, we don't make distributions before we've had a full quarter. The fee structure does vary a little bit based upon the size of the property. We do move the acquisition fee, and I should mention this is a no upfront fee fund, meaning that we aren't taking any fees until the capital is actually deployed. Some funds will take the upfront fee when the money comes in. Of course, our goal is to make sure that we are, if we for some reason didn't and we gave investors money back, that they would get their full amount back. But these sponsor fee, acquisition fees and any financing fees associated vary with the size of the investment, typically lower with the larger investments, maybe a little higher with the smaller ones, just to cover hard costs on our side that have to do with the acquisition. As I mentioned, of course, our partner BeyonderCamp manages the properties. Property management in this space, these are heavy operations to manage. There are a lot of moving parts, a heck of a lot more than managing, say, a single family or even a multifamily property. We've got larger payrolls, larger operations we run. Typical management fees in this space average between about 11 and 14%. Because we own our management company, BeyonderCamp, we're able to provide the management service at a discounted rate. We provide it at 7.5%. And then, of course, the 2.5% asset management fee covers the actual investment asset back to Happy Camper for managing the investment itself. The 3 share classes that we offer have different preferred rates of return, and it's based upon the investment amount. There are more details on this. Don't feel like you have to write everything down now, but all the details for this are in the investor portal online. We have a base Class C share for any investment up to, but just less than $250,000. That would be an 8% preferred rate of return annually. If for investments that are $250,000 to just shy of $500,000, that'd be a 9% preferred rate of return. And Class A shares are for anything of $500,000 or greater. Now, one of the great opportunities that is unlike any other that we're providing with this fund is the ability to level up those shares throughout the investment period. So what I mean by that is if you were to make an initial investment of, let's just say, $200,000 today, that would be a Class C share. However, if after next quarter you were to invest another $100,000, all of your shares, not just those over 250, all of your shares would be upgraded to a Class B share and the higher pref of 9%. And then same goes if you were to bring in another $200,000 in Q1 or Q2 of 2023, then you'd actually level all of your shares up to a Class A share at 10%. Now, one thing we're doing is we're treating this as a ratchet. So if your shares are leveled up and we do a return of capital event, your shares will not be downgraded just because your invested capital goes down. The capital that is invested will remain at the same share class that it is in. So that's all I have to say about the actual structure itself. Let's talk about some of the opportunities and some of the goals that we're looking to. So as I mentioned, of course, we are targeting multiple markets. We're mitigating risk. We're also looking to even out those cash flow humps throughout the year by being in different markets. We're targeting what I call blue chip properties. So these are going to be properties that are already performing. We're not taking any extreme gambles on these. These are ones that have a proven history in their market space. They fit our model. They are a destination property. As I mentioned, of course, having multiple properties comes with other benefits too, is that you are invested now in multiple assets, whereas maybe if you didn't have the funds to make a minimum investment in all 6 to 8 deals that we are invested in, one investment will be spread across all of those to some proportion to the size of the deal. Our team at BeyonderCamp will actually oversee the implementation of any CapEx plans to make sure that it follows our vision, our business plan, and that it stays within reasonable expense. And then, of course, oversees the actual operation of the property. It's important to mention that BeyonderCamp was formed we formed BeyonderCamp to manage our own properties because we frankly didn't trust the other managers with our properties. Having seen what property managers in other spaces, that they didn't always care about, like for example, in the single family, multifamily space, didn't always care about vacancy. Well, we care a lot about occupancy. We want to make sure that our campgrounds were focused upon the investor returns, upon the profitability, and upon the long-term value of the property. So we formed Beyond Our Camp and have actually created a model that we are now able to repeat at scale, not only on our own properties, but Beyond Our Camp has actually begun providing third-party management to other property owners in this space to help them operate their properties going forward. So a typical business plan for us looks at multiple areas. The first one, of course, being revenue optimization. So, what are the things we can do to improve that revenue through online reservation systems, yield management, as I mentioned. A lot of this has to do with the tech tools nowadays. Tech is really one of the big things that has shifted this industry. We have services called OTAs, outside travel agencies. Is to put that in layman's for you. If you've ever used a website like Expedia.com or Hotels.com to find a hotel room, that's an outside travel agency. So we have actually integrated our campgrounds with websites that will let us put our RV sites up on it so that a wider audience can find them. Cabins and any short-term rental units like that you'd find on Airbnb, we list those as well too, to help broaden our search. We also work on, of course, the web marketing and the SEO optimization for that. As I mentioned, our rental units are the core of our business, so we're always looking for opportunities to expand our offerings, either by literally developing more acreage or by bringing more rental units in, meaning that maybe we have underperforming tent sites in one part of the campground, but we're able to add cabins or park model trailers, which are like cabins and trailers combined, that can improve the revenue from those sites and improve the number of nights those sites are rented. We always look at it from the angle of the amenities we can improve. So as I mentioned before, of course, the rental units we can add, the direct revenue generators we can install that are going to bring in extra revenue. And add extra amenity. And then, of course, some of the indirect ones like the aqua parks, these are very popular right now. They're large inflatable structures that go out on a lake or pond that kids can play on. These alone will bring in more campers and fetch higher nightly and weekly rates. However, they will also bring in day pass users from the community who want to come play, especially if it's in an area that has low recreation. We will create the recreation for a community. Things like swimming pools, of course, and then just improvements to the road and the site leveling and things that will make a camper stay better. Expense optimization is one of the priorities of Beyond Our Camp. We actually provide financial report training to all of our managers on site, so they are in relationship with the P&L for the property. We set goals and targets with them and even have bonus structures in place based upon their ability to maximize the revenue of their property and keep the expenses within a controlled budget. And then, of course, one of the big benefits to investors is the asset depreciation. This varies widely on each property. It depends a lot upon the actual improvements to the property because, of course, we can't depreciate the land itself, but we can depreciate the business assets and the improvements on the property. So we do perform cost segregation studies on all of our properties to maximize the potential depreciation for investors coming in. Okay, so like I mentioned, of course, just in closing on the actual fund opportunity itself, the goal, of course, is to bring in, like I said, in this first fund, about 6 to 8 campgrounds. We're targeting consistent cash flows by having those multiple markets in place. We're targeting, hedging against any of the risks that come from being in just one market by being spread out into multiple markets, multiple climates. And of course, we're targeting upside potential in these in the long term and actually having, the tax benefits. Of course, one of the biggest reasons we got into this as Justin and I were camping families ourselves, we wanted to have assets we could actually go enjoy. And that's one of the big benefits that we have for our investors as well, too, is that you can actually go out and see, touch, play with, take your family to visit these. We have a structure in place where investors get to use their campgrounds, for a certain amount of time every year for free. So with that, I'm going to open the floor for any questions that have come in. Don or Brad, have we had any questions come through?
Not yet. No, not in the chat anyway.
Adam, can I add something as well?
Ramesh, please jump in.
Okay. Now, actually, for people who are listening in today, we have the first opportunity that's going to get closed on December 14th. So the funds are still available. The slots are still available to get into that. The fund is open and we are getting to close. And we also have lined up like 2 more properties pretty quickly as well. So there are more opportunities coming, but still people can jump in and take this one. I will also add one more thing. That's right. I do a lot of data and research for my personal interest. And that was one of the reasons I joined the team and being part of this real estate product. Eventually I always look at the growth potential for the next 10 years. And this product in real estate kind of fulfills and check boxes all of those items, right? I see the trend, we've been to a conference in Florida where there were almost 1,000 people, but still it's all mom and pop. There's 12 million small businesses in this country, which is going to transform or go to different younger generations in the next 8 to 10 years. So based on all the data and everything else, this is if somebody wants to need a comparison analysis, this is outdoor hospitality, RV parks, marinas, and campground products in real estate is like investing in multifamily in 2015, 2016 space, right? So you are ahead of the curve, leading the opportunities, and even for the first opportunity that we're going to close on December 14th. We just, I know we don't want to discuss the name of the thing, but still, the appraisal has come in $3 million more than what we are purchasing it for. So that itself, we are already walking in based on our strong due diligence and the capital process. There is a golden opportunity for your equity building process that's happening as soon as you walk into the fund itself. So let me, I just want to put it out there so that people know all the details here.
That's right, Ramesh. Thank you for mentioning that. And of course, this webinar is public today. We did want to open this up to the public so that they could visit. Obviously, we can't speak about the specific properties as Ramesh mentioned, we do have an opportunity in the fund set to close very, very soon. So of course, if you want to see those details, you'll need to get into the investor portal, which you can access at investors.happycampercapital.com. I'll give the link at the end here. But of course, like I said, because of the non-disclosure agreements, we can't share that publicly. We'll just have to have you sign ours to be able to view that opportunity. One thing that's important to mention too is there is a reason to be prudent with getting into the fund sooner than later. The plan right now in the fund is to reassess the share value on a quarterly basis. And so we will be doing our first share price reevaluation after Q4, going into Q1. Current share units are at $1 per share. And based upon the performance of the investments and our outlook, we're going to be adjusting the share price. So it is possible the share price could go up and the units would cost more. So buying them now is going to be a better investment, of course, and just helping get to the goal of getting this very first one closed. And then, of course, the subsequent ones right behind it. So that's worth mentioning. Looks like we've had a couple questions come in. Don or Brad, can one of you guys read those off?
Yeah, so Kumar is asking about during COVID time,
Yes.
If there were shutdowns that affected the industry, if we know of any other funds similar to this one that were operating during COVID, which I don't think there were any funds in this space at that time. But as far as campgrounds in general, how were they affected by COVID? And then, of course, I think as you mentioned with the insurance, that it would still cover the pref return even for the fund itself.
That's right. So yes, good points there. So as I mentioned, this was not an investor grade asset necessarily before 2020. This was not something investors really looked into prior to that. Aside from the big groups, your Sun communities, leisure systems who operate some of the larger properties in the country, and they really only play with institutional money. There were markets that did see shutdowns from COVID in 2020. However, we have a very strong lobbying body in the outdoor hospitality space who made outdoor recreation, outdoor hospitality considered an essential business in most markets. So those operations that were shut down early in 2020, before when we were playing with new rules that we'd never played before, were allowed to reopen a short time thereafter. So the markets we were in at the time, like I said, they did see some of them saw temporary interruptions, some of them saw no interruptions, but most of those were allowed to reopen because they were made essential at the time. So the hope, of course, being that we won't experience that again. But of course, the other side of that being we hope is not a strategy. So we insulate that with insurance of having the lost business income in place to cover at least the pref on that. Good question. What's next?
We've got somebody that wants to actually ask a question live. So you're going to unmute yourself.
Yes, I am unmuted. Hi, this is Narayan. I have actually a few questions, if you don't mind me asking all of them.
Okay.
And I can shoot one at a time if you want.
One at a time would be great. Yeah.
Okay, great. So great presentation. You did address my biggest concern where I had about commuting with the high gas prices.
Yes.
And I like the model approach. The questions I have more on the finance side. Number one, I hear you say that you are collecting the funds now for a period of a year, and then you are going to deploy it in a year from when it's closed. So what is the incentive to invest now rather than wait until the closing time and then invest? So my money is getting some returns. That's the first question.
Great question. So, and I'll clarify that a little more. We are leaving a period of up to 1 year following the close of the fund to deploy all capital. However, the structure of the fund is fluid in that we will be deploying capital as we raise capital. So a great example is the opportunity Ramesh mentioned that is closing in December is going to be deployed from the fund. And we will have several investments. It's possible that at the close of the fund, when we've done the full $25 million in raise, that we've already earmarked it all, and we might have it all deployed within a month of the close of the fund because we bought several properties throughout the coming year. So the term closing of the fund is just more of a legal term our lawyers use to describe when we actually stop collecting funds. But we will be deploying capital as the year progresses.
Got it. So in the worst case scenario, if you didn't deploy it and if the cash is sitting idle, will you be at least investing the cash somewhere in the short run so our cash is yielding some returns?
That's a good question. We had not had a plan to do that. That would be, I don't know that we can actually legally even do that. We are a private placement opportunity. I think we would be violating SEC regulations if we took your money and acted as investment advisors and invested in other spaces. However, I can assure you that our problem has not typically been not being able to deploy capital. We are excellent deal finders. As I mentioned, we cherry pick really the top of what we find. We have many opportunities in our pipeline. Brad and Justin Nanny, who are our acquisitions guys, have some outstanding opportunities and really our limitation in the past has just been the access to the capital needed to purchase those assets.
Adam, I would like to add one thing to that question. Right?
Please.
It is just an in-case scenario. Most of the times, basically what we have done so far in the past 1 year is, as soon as the funds accrue, we already lined up properties pretty much, right? So money is not going to be sitting there ideally doing nothing at any given point in time, and obviously, we are not going to be anticipating that is going to even happen before the fund. Now, I'm basically thinking if we raise $25 million, we might even close the fund in 8 months or 10 months before even the 1 year time frame that happens, as long as all the money is being deployed, which is a very high possibility. But obviously, as attorneys suggest, they always want to keep up all the different scenarios in place, just to mitigate that. As per SEC, I think if the funds are not used, probably it has to be returned back.
Okay, got it. Thank you. My second question, you showed the preferred returns, Class A, Class B, Class C. Is that the cash disbursement after every quarter, or what does that percentage actually mean?
Yes, so that's the preferred rate of return is based on an annual basis. And we do at the close of each quarter, I should say at the close of each full quarter, based upon the performance, when necessary, a distribution can be made.
Technically the first year might be a lean year because of the capex business plan implementations and everything, but overall, when it's a preferred return, technically that money has to be distributed first to the investors before anything else kicks in. If something is delayed, like say for example, we are able to distribute instead of 10% for the type Class A, we distribute only 6% or 8% on year one, then technically it will accrue and do a catch up eventually when the money becomes available. So end of the day, before the property is sold, these pref returns have to be distributed for the investors to begin with, and then only the profit will be calculated.
Okay, got it. That helps. Thank you. And then the next question, you said there's 65% investors and 35% general partners. That's a ratio. And how does the money that you borrow from the bank or the lenders play into that? What percentage?
Well, the ownership percentage, so the bank doesn't own any percentage of it. But if you're talking about when the debt is paid, the debt is paid before any distributions are made. So that is one of the operating expenses of the property.
So what I think what I'm referring to is how much is the general partners putting in money and how much is being collected from the investors like us and how much is being borrowed. The money.
Sure. So yes, we do leverage these purchases with debt. The typical terms we see are about 70 to 75% LTC, loan to cost. So they do vary. But as far as how much capital the general partners are putting in, we invest as limited partners in our opportunities. However, the general partners aren't actually responsible for bringing capital to the deal. We're responsible for actually making the deal happen. We take the risk, of course, on just finding the opportunity. We do put the risk capital up. The earnest money is the hard cost toward the purchase and such. And in exchange for that, over the life of the purchase, we're looking at a 35% ownership of the asset itself. We do have an IRR threshold, and I'll bring that slide back up here real quick. We do have an IRR threshold, and it does slide based on the share class, because if we set it as one number, it would disproportionately affect the Class A shares. That once we have achieved, and of course this is at liquidation, this is not during the operation of the property, that once we have achieved a certain IRR threshold, the ownership of the remaining funds would go on a 50-50 basis, not the total amount, but just those over the IRR threshold.
Yeah, in simple terms, the stack is the first we pay the debt, next we pay the capital. So the third, all the pref returns have to be paid, and then only even these splits kind of come into play on the profit or the excess distributions is available on the cash flow.
Got it. Okay, great. And last question, in the worst case scenario, if some disaster happens like COVID or something like that, and this industry falls apart, do you have a backup plan on how to use these properties to generate revenue?
Yeah, I would say that our fallback option is always that if every other precaution that we put in place fell apart, the worst case opportunity is we can convert these into residences. So we could, effectively that model that I said we don't pursue, that's the nuclear option, let's just say, is we can turn these into residences, and they wouldn't perform as we project. I'll disclose that, but we would certainly do everything we could to maximize the potential in these and make sure that we can at least keep them solvent. And
the zoning is appropriate for changing into residences?
In most cases, that's not an issue. It's that we can do it. We're able to write month-to-month contracts. So, we'd be basically treating them as month-to-month tenants.
Okay, great. Thank you so much for answering questions.
Of course. All right.
And we've got one more question here from Steve asking about the number of shares as you referred to, the quarterly valuation of the share price and value. So he's asking, how does return differ if I invest now versus a year from now, assuming the amount invested is the same? So if I put in 100,000 today versus 100,000 next October, we'll say, what's that look like?
Well, do you want me to take that, Adam?
Please take it, Ramesh.
Okay, thanks. Yeah. No, actually, no. They're going to evaluate the performance of the properties every quarter, and that is going to dictate the share prices. Right, as of now, the share price is $1, and based on appraisals and the performance and the revenue generation, everything else, say the next quarter it might be. No, I'm just throwing a hypothetical number. It might be $1.05 for the same share. So you might be investing $200,000, but you might not be getting the same equity or the same shares like the one you invested to begin with, right? So that will be the difference. And this number is not going to go down. It will probably either stay same or it'll go up depending on the performance of the properties and actuals like we are going to be doing it.
Good question. All right. Do we have any other questions?
How does future interest rate increases impact the returns?
It's a great question. Interest rate increases definitely had a big effect on our projections this year. Obviously, interest rates on every type of loan product have gone up this year, and we weren't exempt from that. We have seen some stabilization in those interest rates and actually even a little decline recently. When we do our underwriting, we are underwriting at much higher interest rates than what we're currently seeing. We're typically going up at least the past few months, at least a point, if not a point and a quarter in some cases, over what the banks are quoting us, just giving ourselves some opportunity in case the rates were to increase. We were recently pleasantly surprised that C1 actually went down from what we originally quoted. I will expect that they're going to stay high for the next year. This will be something we have to consider as we do our underwriting going forward. So again, as I mentioned, we scrutinize every property. We won't just bring something forward just because we have it. We have enough opportunity. We have enough deal flow that we can still be picky about what we take. We aren't just left, taking table scraps because it's the only thing out there, which is a nod to our processes in acquisitions and finding deals.
I think, Don, I think Steve is asking why it won't go down based on what I said, because just to provide the investors the advantages, like whoever is coming in first, people might invest through the entire 1 year time frame, right? So just to incentivize the investors coming in first, either the shares will go up or based on the performance, and because of that, sometimes the appreciation also happens, right? So we're going to consider all the factors, and we will either keep it the same, the share price, or it'll go up a little bit.
Yeah, we're very, very similar to like a stock price. 10 years ago, you could have bought Tesla stock for like $1, and now it's going to cost you a lot more. So because you know what it does. One final question here is there any disposition fee? That's not on this screen, I don't think.
Good question. No, the disposition fees, they tie to the sale. They're in the PPM, which is in the portfolio. There are a lot of things that we really couldn't fit in this presentation. And of course, I wouldn't expect everybody to actually, have an interest in knowing all of those particular details, or if they were to see them. So those are in the PPM, along with refinance if a refinance event were to happen. So all of those things can be found in the investor portal. In the interest of time, because I know we're a little bit past our time already, and I want to be respectful of yours, I am going to close questions for the day. I'll encourage any further questions to bring those questions to our investor relations team. So Don and Ramesh, for example, they can either share their contact information in the chat, or of course they can be found through the website. We have at happycampercapital.com. Their contact info is up there. And of course, we'll be happy to answer any other questions or jump on another follow-up call offline. All right. So with that, thank you everyone for taking some time out of your day. Like I said, we are a little over our time. I appreciate you sticking around with us. I want to be respectful of the rest of your time today, though, and make sure that I don't hold you any longer. I know some of us are in our work days, and I want to make sure that we are not encroaching on any more time. So thank you so much for coming.
Thank you, everyone. Yeah.